Okay, I'm Gosh Soffer. I am the co-founder and managing member of Rion Capital. We are, as you can see, a fixed income relative value fund. Our focus is on structured products, predominantly in the U.S. And in general, we use little to no leverage, and we try to not be very directional. The fund was launched in September 2011 by myself and my partner, Sui Gilram. I formerly run this strategy before at some buy-side firms, and my partner has been a senior guy on structuring and trading of these type of assets. Anyway, on to the more interesting stuff. The market I'm going to talk about is actually a little bit different than the corporate credit that a lot of people have been talking about. It's actually the US CMBS market. And as a former credit guy, I found this to be, to put it bluntly, one of the greatest markets to make money in. And that's in all kind of ways: outright longs, outright shorts, capital structure arb, and the specific strategy I'm going to talk about, which is negative basis. But first, a little bit about what is CMBS. So very, very briefly, CMBS are basically structured securities backed by pools of commercial real estate loans. These pools are generally diversified across asset type, across size, across location, etc. General pool might have 150 to 300 loans in regular conduit US CMBS. And then there are structured securities. Over there is a very kind of simplistic picture of the structure. However, I will point out that the structure is, relative to a lot of other securitized products, quite simple. Generally, losses flow from the bottom, and principal is paid down from the top. So, along with CMBS are the CMBX indices, which are synthetic securities that reference different pools of bonds backed by different vintages and different sort of slices of risk. And the existence of this index and the fact that it's liquid is critical to a lot of the opportunities in the market, especially the one I'm going to talk about. And it's a very unique thing to the US CMBS market. It's one of the few markets that has a real liquid hedge of not only the underlying collateral, but also of structure, which is very difficult to find for, say, the CLO market or even the ABS market with ABS. It's not exactly the most liquid and matches as cleanly with a lot of the assets people are buying. So with that, I'll go on to the strategy, and one of the strategies that we do, and that's CMBS negative basis. So negative basis is a pretty simple strategy. You buy a bond, or a pool of bonds in this case, you short the bond through synthetically, and you hope to be left with a quote-unquote risk-free bond that yields significantly more than treasuries. And now, what makes CMBS so special versus doing this trade in IG corporates or in high yield is simply the size that the basis becomes, and size does matter. So that's basically the type of opportunities we've seen in CMBS, I would say on the conservative side, in terms of the magnitude of the basis. I mean, these are comparables to sort of the type of opportunities we've seen in high yield or IG basis over the past 9 months since we started running the fund. So, these numbers are real. We've been able to put on 500 to 1,000 to bases, 500 to 1,000 bips wide. I mean, that's a lot of these assets have a duration of about 4. That's 20, 25, 30 points of value of just essentially quote-unquote free money that the CMBS market is giving without leverage, without, it's crazy. And that's essentially the opportunity. And this opportunity, my favorite part about this opportunity is that it goes away, but it always seems to find a way to come back. And that's what makes it really exciting, because not only can you lock in this tremendous amount of value, you get opportunities. I would estimate over the past 3 years, I've probably had 2 times a year opportunities to put this trade on and realize the majority of the spread compression. We've seen that actually in the past quarter for the fund, which has been a good quarter for us. And right now, we're seeing a little bit of widening in basis, and we anticipate that it will continue to widen and we'll be able to do this trade again. And that's pretty much the trade. And unfortunately, as with every trade, there are risks. The core risk, I would say, in this strategy is the idiosyncratic risk. It's not always easy to find every single bond in the index. Generally, you may not want to. And we don't want to even if we can. However, that exposes you to some basis risk. There are also risks of counterparty risk. There are timing risks. When these things may default, if they do, is uncertain. And a host of other risks. But at the end of the day, this is a market, and this particular strategy, something that we've seen available over the past several years, kind of on and off, that has allowed us to generate, hedge fund-like returns with very little to no leverage and almost no directional risk, which is simply a type of risk-reward profile that we haven't found in any other market. So the first question is, what if liquidity in CMBX dries up when you want to unwind basis? That's obviously a risk. We think this is a smaller risk than maybe some people are anticipating simply because CMBX right now is one of the only truly liquid hedges for structured products. It's, for right or wrong, used by dealers and a lot of structured product players in general as a hedge. Furthermore, there's new issuance coming into the market in CMBS. People anticipate 30 to 50 billion of new issuance of cash, and dealers are already in discussion of CMBX version 6, so a new index to link to some of these newly issued deals. So this is definitely a risk, and fortunately, because of how the trade is constructed and the bonds have fixed coupons and the index has usually very low spreads because when these CMBX were done, everything traded at 20 bips. You can actually kind of ride out the trade because you're collecting cash. It's a positive cash carry setup in general. So you can wait. That's not ideal, but you're not stuck in a trade that isn't going to just do anything. You're in a trade that will at least pay you carry. And that carry can be sometimes very significant, depending how wide the basis is. So, I mean, that's how I would answer that. I think, it's potentially a risk. If it happens, you just kind of sit and wait and collect carry. But we don't think it's going to happen because issuance is back, new indices are coming in, and this index has been used to hedge other assets, which are still around and still probably going to be around for a good amount of time. There's a bunch of questions.
Hey,
what is the minimum investment? I like that one. It's talk to me. A million is kind of the quoted minimum, but anyway, the other questions: how persistent is the liquidity in CMBX indices, and how does it behave during periods of market stress? It's volatile. I mean, anytime you have an asset where basis can get this wide, you have to anticipate that there's volatility and technicals that are driving that. Liquidity in general in CMBX and even in CMBS is quite good in terms of size that trades, but the market moves a lot. You'll have days where CMBX will move 4 or 5 points in a day, but 10, 20 million trades at a clip, even higher, are generally doable, even in these very volatile days. And that's the same with the cash market. Probably trades too big for its own good, but that's okay. So there's more, what are your return target net of fees, and what are your fees? Our fees are quoted as 2 and 20. Our return target is sort of double-digit returns, 15%, maybe, depending on market conditions, maybe 20%, maybe 12. Currently we're at about 8.5% for the first 4 months of 2012.